FIG is Australia's largest fixed income specialist. We're a privately owned company and we're not aligned to any financial institution. Founded in 1998, we have developed unique fixed income services and over 6,000 clients. We've built a strong reputation in the corporate bond market through our innovations such as our direct bond service, managed income portfolio service, and a suite of online technologies such as our smartphone app. With over 130 employees in offices in Sydney, Melbourne, Brisbane and Perth, we have a broad team of fixed income experts with a wealth of industry experience. We service clients from all sectors, including private clients, financial advisors, not-for-profits, small to medium companies, institutional investors, family offices, as well as statutory authorities. Our clients have access to high-quality research, market insights, custody, education, and of course a wide variety of corporate bonds. Our clients enjoy the benefits of owning direct bonds, which traditionally have only been available to large investors such as institutional fund managers in $500,000 parcels. Our direct bond service, launched in 2010, allows clients to invest in over 300 bonds from household names such as BHP and Qantas from a minimum of $10,000 per bond.
Not a lot of people in Australia invest in bonds, but it is actually a category that allows you to take a very different approach to market risk. There was a famous saying by Jack Bogle that you should own your own age in bonds, which means that if you're a young person starting out with your super fund, you should be looking at maybe 25%. As you get through to retirement, you're looking at more like sort of 60, 65%. And as you get through to sort of towards the end of your retirement, let's express it that way, you're talking more like sort of 80, 85, 90% bonds. Now that's a rule of thumb. You don't necessarily want to say that as, take that as holy grail, but it is quite an important thing to understand. And unfortunately in Australia, partly because superannuation has been so successful, everyone starts young when it's appropriate to have a really strong equity-based portfolio, and they get through to retirement and they think, well, why should I change what I'm doing? Well, the answer is you should change what you're doing a little bit, because when you're 20 years old and you've got an investment horizon of 60, 70, 80 years, that requires a different set of investments than if you're already 80 years old and you have an investment horizon of maybe 15, 20, 30 years. Let's be generous, sir. So, despite being one of the world's largest investors in equities, Australians are very, very, very unwilling to invest in bonds. Now this chart here isn't particularly easy to see. I'm glad the screens here are nice and large. But what you can see here is this chart shows lots of different countries split by what proportion of their investments they put in bond markets. So you've got the Russians all the way at the top there. I do. You come through France, Germany around here, and Australia down here. Something like 14% of their portfolio in bond markets. That's not very much. It's not very much at all. The question then becomes, why would you want to do that? Why would you want to have investments in bond markets? And the answer is because bond markets and equity markets behave in very, very different ways. Everyone knows about diversification. You should diversify inside your equity portfolio. I'm here to tell you that if you've only got an equity portfolio, you're not diversified. It's sort of definitional. If your portfolio is only in equity, you're not diversified. Let's have a look at what bond markets sort of do. It is true, and I will never try and sort of claim otherwise, that if you want to get a portfolio that is going to return 30 or 40% in 1 year, that needs to be equities. The trouble with a portfolio that can return plus 30% in 1 year is it can also return minus 30% in 1 year. And that tends to happen comparatively frequently. got minus 20% up there around 2003, minus 40% around the GFC, minus 20% in 2020. Apologies. Sorry? No, it's not. Sorry about that. I'll stay here. The problem with a 40, it might look like you got around the GFC there that you had a 50% loss followed by a 50% gain. The problem with that, of course, is that a 50% loss takes you from 100 down to 50, and a 50% gain goes you from 50 back up to 75. So if you go minus 50 plus 50, you're 25% in the hole. But the other really interesting part about the financial crisis, which was curious because people talk about the financial crisis, the other name for it is the credit crunch, where credit bonds did particularly poorly in some ways on some measures. And yet, in that year when equity markets put down minus 40-something%, bonds, including credit bonds, the credit bond index went at plus 15%. So it's not just about less correlation. This is true negative correlation from investing in bond markets. When the equity market starts to fall, they all fall together. When the equity market starts to fall, what tends to happen is that the bond market rises. That's because when do equity markets do the worst? They do the worst during a recession. What does the RBA do during a recession? They slash interest rates. If you've got a fixed rate bond where you've got guaranteed return and interest rates are falling dramatically, you're going to do really well out of that. That's what bonds bring to a portfolio, is this correlation, this negative correlation to your equity investment, so that even in the worst investment times, one part of your portfolio is doing really well. This chart here shows bond performance versus equity returns. You can see equity returns on the x-axis going from minus 40% up to plus 40%, and there is a negative correlation there. When bonds are doing their worst, so when equities are doing their worst, bonds tend to be doing very well. That's that top left corner, which I've labelled, phew, bonds saved my portfolio. That's what they're doing. They're trying to bring in an entirely different source of investment risk, so that if we are unfortunate enough to have quite a large drop in equity prices, and I am by no means an equity analyst, but the articles that I read which are written by equity analysts tend to suggest that the current equity prices are incredibly high on price-income ratios, so that at a certain point it'll be a time for a correction sometime in the not too distant future. When that happens, that's when you will see bond markets come to the fore and provide that diversification. Now, if we go back a slide, you'll see that I've been talking a lot about the financial crisis and sort of saying that during that period when equities did particularly poorly, bonds did particularly well. That's what the theory says, and that's the best example, and that's how it worked. It didn't work terribly well during COVID. During COVID, you had really quite a large drop in equity markets, and then you didn't have much of a rise in bonds. Why does that happen? That happened because there wasn't really any space for bond yields to fall. If yields, as you can see in the financial crisis there, the yield on the main government bond indices fell from around 6% to around 3%. So anyone who'd locked in that 6% return looked like a genius, and they had huge gains in their bond portfolio. Around COVID, the yield was already around 1%. There just wasn't space for the bond yield to fall, because bond yields move inversely to prices. So to make a gain on your bond portfolio, you need to have the bond yield fall, and there wasn't space for the bond yields to fall. But look where we are now. We're back up around 4 or 5%. So if we had something go wrong now, and I'm not suggesting that it's about to happen, but if it were to happen, there is a lot of space for that bond yield to fall, and that would create a huge gain for bond portfolios. So if there was to be a 20 or 30% fall in the equity market over the next year, I could reasonably confidently say that if there is that 30% fall in in equity prices, you would see a very strong 10, 15, 20% return in bond prices. So how does that actually work? I realise I have made a small mistake here. I probably should have told you a little bit more about what a bond was before I started talking to you about how well they work. Just to take a quick step back, a bond is like a loan to a company. When you buy an equity, you own a small piece of the company. When you buy a bond, you've lent money to that company at either a fixed interest rate, where they say, right, it's going to be exactly 6% or exactly 5.5, whatever the number is for the life of the loan, or you can have a floating rate note. But if you've locked in that fixed rate investment, it doesn't, so long as the company stays profitable and stays in business, they have to pay it back to you. You know, if the company does really poorly and is just scraping by, they still owe you every single dollar that they've agreed to give you. Now, the flip side of that, of course, if the company does very well and can easily pay you, you don't get any further upside. But you've guaranteed what your investment return is going to be in all instances other than the default of the entity you've bought the bond from. So if you're buying a comparatively safe bond, like a government bond or a state government bond, the notion that the federal government might go bankrupt is technically possible, but really pretty small. And if the federal government is bankrupt, we have a lot more problems than a bond portfolio. That guaranteed return sits there, and you're going to get that regardless. You have guaranteed your income, you have guaranteed your capital, and on that mark-to-market basis, you're protecting yourself against the worst outcomes on the equity market for the years those occur. So what can you actually expect to achieve from a bond portfolio? The honest answer is that a lot more than you probably expect. I won't tell you the exact number because I know there's a guessing game going on as to what the actual return was for a FIG client over the last couple of years, but it's probably more than you expect. A bank term deposit, you'll get sort of 3 to 4%. If you take a really conservative bond portfolio, you can get a 5 to 6% yield. If you take a balanced portfolio, you can get 6 to 8%. If you take a high yield portfolio, you get 7 to 9%. That's on current yield to maturities. Now, I won't go into this too deeply, but I did financial mathematics at university. I can tell you that the yield to maturity actually underestimates the likely return on your bond in the short term. So these are underestimates of what you would probably achieve in an average year, because the yield to maturity is the yield if you hold that investment all the way to maturity. If your bond advisor, for example, your FIG relationship manager, suggests to you actually now is quite a good time to exit this particular bond, it's already performed very well, you can outperform these numbers and stay within that risk category. So I hope you understand now that the basic premise of bonds is that they are a much safer investment than equities. They very rarely have huge returns, they very rarely have huge losses. And in fact, the years where they do have very strong returns tend to be the years when equities are doing very poorly. So as part of a proper diversified portfolio, you should definitely own some equities and you should definitely own some bonds too. And as you're approaching retirement, you probably need to think more about conserving the capital you've already created and ensuring the income across your retirement. And the best way to do that is with bonds. Thank you very much.